Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He's speaking to us from Colorado. Rick, I know we're into earnings season, but is it very profitable for U.S. companies right now?
Well, it's funny, you know, we're at the paradoxical stage where declining earnings have been reported for 6 straight quarters, and it gets so that the comparison, the number to beat is so low that companies are starting to beat, you know, the year over year. And it's on the way up, of course. The earnings game was the same 3-card Monte grift where, you know, the estimates would be just calculated to be that they'd be kind of rotten, you know, and then it was a question of can you beat the rotten estimates, and many firms did. So the beat estimate story worked on the way up, and now, you know, the estimators and Wall Street have this factor going for them that year over year that they're going up against some pretty punk numbers.
Right now, is that a good comparison usually?
Well, I would say you need to look at it in absolute terms, you know, or companies going great guns, and just the fact that so many are taking all of their spare cash and buying up their own stock suggests that business is not so good that they all want to grow.
Should investors be aware of who's buying stock?
It's an interesting question, you know, when you think about it, whether you're buying stock or not. If you're, let's say, a California state employee, CalPERS is out there acting as your proxy, and we've all got those proxies, you know, whether through pension funds that we belong to, or pension plans that we belong to, or even the companies that insure us, life insurance, auto insurance, healthcare insurance. They all put the money, more in the case of life insurance, of course, but they put the money into stocks, and they factor 8% for the next 20 years, and of course we've had a bit of a shortfall since then. So if you consider who's doing the investing, we're all in it together, whether or not we invest directly as individuals or not.
Well, Sun Life in Canada several years ago had guaranteed their customers that they would get an 8% return every year, and that the return would be good enough to start paying your premiums, and you wouldn't even have to pay your premiums every month. Well, that resulted in a class action lawsuit that saw their clients receive millions and millions of dollars in compensation because they never did meet that 8% goal.
And just imagine how that same promise is going to play out on a much, 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 much grander scale with respect to public pensions. You know, they're still essentially acting as though the investments they've made will return certainly in excess of 6% over the long haul. And you really can't square that with growth forecasts. This would be for the U.S. economy that are sub 2% as far as the eye can see. And, you know, at a demographic level, we've got so many baby boomers retiring now that 2% growth looks like a dream at this point.
Is there any place besides the equity markets that promises more than 2%?
You have to be a player, you know. You need quite a few bucks to be able to get into that league. Let me give you an example. They built we have a highway that connects Denver with Boulder, Highway 36, and it was a toll road up till the early 60s, and then it finally paid for itself, and they made it free. Well, now it's a toll road again, and there's a lane, they call it the Lexus lane, and for the very short trip between Boulder and Denver, under 30 miles, the round trip toll can be as much as, I think, $30. So initially, the company that put this whole deal together and built the road said, well, you know, we've we've got authority to raise the tolls to 30, but that's just you know, it'll never happen. But that promise is held almost like Obamacare. You know, if you like your current provider, you can keep it, and so on and so forth. It was a fraud. It was a lie that was sold to the public. Well, guess who built that road? It was Goldman Sachs. They put together the consortium that built the road, and incidentally will collect tolls for the next 50 years. And Goldman's guys are so smart that they figured out there's some pieces of this contract, one of which is if any town that is along the 36 corridor builds a road that can be construed as having taken traffic away from 36, then Colorado taxpayers are on the hook for the shortfall. So who could put together something like this, and especially something that would not have sold to the public if the details had been known earlier? Well, it's Goldman Sachs. Why did they build the road? Well, you would think it would be to accommodate more traffic, but it wasn't. It was simply a bunch of guys at Goldman sitting around, and they said, how can we create some stream of revenue that will service an 8% bond? And this toll road with its exorbitant tolls was the answer. So you can bet that anybody who took a piece of the bonds, warrants, and stock that built that road is not. They're probably accredited investors, meaning they have at least a couple $100,000 of liquid net worth over and above their homes, and so on and so forth. So, you know, it's only the big players that are getting in, and not just for deals like this, but for private equity placements like, Uber for one. So private equity is in so many deals, but they're not for the little guy. And if the little guy can take any consolation, it is in the fact that eventually all these private equity deals are going to come crashing down.
Does anybody take that $30 toll road?
Well, Goldman's thought everything through. There are a bunch of really sleazy but very, very talented operators. And they've left if you have two people in the car, you get to ride the toll lane free. But that's just really to get people in the habit of using that extra lane, because they're going to make it, they're going to require 3 people in the car for the toll lane to be free come January 1st. And, you know, that's going to be a rude shock for all of us who have enjoyed it. The road really, it didn't expand the road in most places, by the way, and true to the sleazy nature of this and opportunistic nature of the deal, it didn't even cure the traffic problem. There's a major bottleneck for people leaving Boulder trying to get onto 36 to go to Denver, and the expansion of the road did not encompass that last half mile or so that would have alleviated the bottleneck. So you could say that Goldman doesn't really care about the traffic problem. They just want to get people, as many people on the road as possible, and collect tolls from them. So that's the way it goes. And you know, across America, you have these public-private partnerships, and of course that has a nice sound to it in a headline or in a news article about, hey, Colorado's getting a new highway, and it won't cost taxpayers a dime. But you read between the lines, and they're basically saying, we tax each and every one of you motorists to death by way of taxes on gas, on tires, on registration, you know, on pretty much everything. And yet, when we pay our own employees their pensions, their monthly pensions, everything we could possibly raise from you in the way of taxes is already spent. We can't afford to build new roads. So we pay huge taxes to operate motor vehicles on the highways and byways, and yet it hasn't. Now the locality, states, counties, cities have to team up with the federal government to build toll roads.
We'll have more with Rick Ackerman right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Rick Ackerman. Rick, they say we're into the earnings season, and again, we talked about those numbers. Do you think that people are going to catch on if they compare year to year, that these numbers don't really mean a lot?
Well, if they were going to catch on, I think that would have occurred 50 years ago. You know, the whole earnings game has always been a shell game, and you know, if they don't misstate the earnings, they simply change the accounting rules so that technically the earnings are properly stated. But no one except a Wall Street analyst could make sense of these of the ultimate meaning of earnings numbers.
What about this surge towards protectionism? If we hadn't sent all those jobs to China, we would still have jobs here in North America.
Well, I think like everything else, if there's a huge, huge problem, the bigger the problem, the more likely it is that government is its cause. And, you know, what you've just mentioned, it's a very big thing, you know. To put it in the biggest possible frame of reference, I would say that if Americans were not essentially hardwired to consume, if consumption which generates 2/3 of our GDP, had not become a national habit since World War II, and we had savings on a par with the Japanese, then we would have used those savings to modernize our industries, and we would produce things so efficiently that we could be making all of our own cars here and enjoy the advantage of not having shipping costs imputed to the price of a car. But what we've done is we've underinvested over the entire post-war period, so that instead of becoming competitive with the rest of the world, the U.S. has become import dependent for so many things. And you know, ultimately, I come down on the side of David Ricardo and Adam Smith, and the idea that if someone else can produce something cheaper, you're better off letting that person produce it and underpricing it even, because it frees up, it generates additional savings on the consumer end and therefore additional investment. So I don't think there's really any arguing against that point. But when you finally get into the argument, it takes into account tariffs and currency wars and everything else. So the government's involvement has sort of skewed the natural, the ability of an economy to create itself, to grow itself organically. And the more rules you have, the less you have free trade. But I don't have any doubt at all that if we had free trade, that it would produce huge economic improvement throughout the world.
Well, for example, if you're a Canadian shopper, you go to the U.S. and you come back, you have to pay tariffs on clothing, and Canada has no clothing industry whatsoever to protect, and so on. If you have jewelry, they want to know where you bought it so they can charge you tax on that, and if you don't pay tax or tariffs at the border, they'll seize it. That doesn't seem to encourage trade between Canada and the U.S., and we're supposed to have a more or less open border.
But in theory, you know, if you let Taiwan produce, you know, fleece pullovers that they can sell to a wholesaler in the U.S., an importer, for 11 cents a piece, it's all to the good if we can buy those pullovers for, you know, $8 at retail, because you know, if we're going to cost us $10 to manufacture the same fleece pullover in the U.S., it's money saved, really. And the problem is that the incentives to take that money saved and invest it in productive capital have been so completely distorted, again, by government policy. One big example would be, the mortgage deduction. The fact that we can deduct interest from mortgage payments is very seductive, but it has pushed a lot of investment capital into real estate with, I don't have to tell you how inflated real estate prices are. But that's not true wealth, it's merely inflation.
Well, in Canada, you can't deduct the mortgage interest on a primary residence. But we do not have to pay tax when we sell that primary residence either.
Well, you can here, and I know that it's the difference has not really inhibited the inflation, particularly in your neck of the woods in Vancouver. I had an interesting stat I wanted to share with you, by the way. I was down at a conference last week called the Irrational Economic Summit. It was presented by Dent Research, and Harry Dent basically is saying we're at the brink of a huge collapse, and I certainly believe that myself. But concerning the Chinese real estate boom, 78% of their wealth is I'll use the word invested in real estate. That's about more than twice the figure for the U.S. And the average, take a guess what the average apartment size is for these spec investments in places like Shanghai.
I don't know, 500 square feet?
66 square feet.
Get out of here.
Which means that no matter where you sleep in your little investment cubicle, you're going to be right next to the toilet. All right. So the average apartment size of these real estate investments in places like Shanghai is 66 square feet. All right. Question 2. What is the average value for one of these investment units?
I have no idea. I guessed wrong last time.
$132,000. So they've got 78% of the average Chinese household investor has 78% of his net worth tied up in a unit that on average is 66 square feet and with a valuation of $132,000. And if that ain't a bubble, what is?
Well, what's their surprise going to be? Of course, in China, they have this conundrum, too. They've built all these artificial cities for about 600,000 people at a pop. They have hundreds of them. They're empty. And yet, in places like Zhangzhou, people are still lining up by the thousands to buy these micro apartments. Right.
They've always venerated real estate investment above all else. It's like they're not making any, there's not making any new land. And although that's true, things get so pumped if everybody gets the same idea that real estate is the best place to put your money. Well, it's not only sowing the seeds of a collapse in China, but also in of course, Vancouver.
Well, Vancouver's already seen over a 20% drop in the value of houses. However, condos have maintained their value, and they're still building thousands of them. So I guess it depends what's built and where it is. Plus, we have a 15% foreign buyer tax in Vancouver now.
Well, but you know that the condos will eventually get marked to market on their income-producing capability. So if everybody's got negative carry, you're going to see prices collapse. Well,
when you have the biggest bubble, in fact, Vancouver, apparently, according to real estate consultant Ross Kay, has set a North American record for the biggest, rapidest collapse in real estate, a drop of over 20% in less than a year.
Uh-huh. Well, keep your eye on San Francisco, because there's no doubt that the pumped-up real estate there is attributable in large part to such as $60 billion valuations for a company like Uber. So, San Francisco, everybody out there on Valencia Street paying $26 for a hamburger works for Google or Uber or LinkedIn or Twitter, And of course, some of those companies won't even be around in 5 years. To mistake the ridiculously high market valuations of those companies for sustainable wealth is going to be a grave error. Someone mentioned to me, by the way, that San Francisco, the Bay Area, had reported a downtick not only in property sales, in prices, but in rental prices too. So I don't know whether this is the beginning of a collapse, but it's coming.
Rick, thank you so much for chatting with us.
Always a pleasure, Jim.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He was speaking to us from Colorado. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.